Hey guys, Dave Silliman here, CEO of EasyOZ. I just want to bring you a quick video today. I'm going to break down understanding the opportunity zone market space just as a whole. So I'm not going to dive into the program, the ins and outs, or any of that kind of stuff. But this is going to be more like an economics video so you understand, how things are moving within the opportunity zone ecosystem. So what you got to understand is that you have two main components to the opportunity zone ecosystem. All right, you have the funds, and then you have assets, basically businesses that the funds are investing into. Now, this is going to be for both real estate and just general business in general. Okay, so you have these two components that make up the opportunity zone ecosystem. Now, component number two. The capital that they're looking for is coming from component number one, which means everything really revolves around component number one, which is the Opportunity Zone Fund. Now, the reason why the Opportunity Zone Fund is so important, and I've explained this in other videos, is because it does the reporting to the IRS. So it's the bridge that makes the connection between who, what, when, where, why, and how. Okay. Now, the Opportunity Zone Fund market space, you got to understand, is broken into two component or two sectors in of itself. All right. You have open funds, closed funds. So let me break down the delineation between the two. Open funds typically are opportunity zone funds that are raising capital. They've identified some sort of opportunity zone asset. So a real estate development of some sort, maybe a business that they want to invest into, but they've identified something in an opportunity zone and they're raising money for said something. Now, that's an open opportunity zone fund, and they're raising money because they're taking money in from people that they don't know. So investors that are not friends, family. Okay. The other side of that is the closed fund market space. Now, the closed fund market space is just the exact opposite of the open fund market space in most cases. 95% of the time in the closed fund market space, what you have is a friends and family situation where an opportunity zone fund is being set up. It's being capitalized with capital gains, but it's being set up for the purposes of stopping a personal time clock. So that personal time clock is John, Jane Doe investor, whenever they sell something, like let's say they sold crypto for capital gains, okay? They're on a time clock on saying from the date that they realize that gain, they have 180 days to invest that gain into a qualified opportunity zone fund, so that way they can claim the deferment and begin to start a longer time clock for the 10-year period of reaping a full step up in basis to fair market value at time of exit. Okay. But so you have this ecosystem that is open funds, closed funds. Open funds typically have the property, closed funds typically have the money. However, your open funds, because of the fact that they are taking money in from investors that they don't know, they're going to be required to register as well with the SEC. So they're going to end up having to do a Form D within 15 days of the first investment coming into the fund. All right, so we have an ecosystem where we have these vehicles that are open and eligible for anybody with capital gains. Now, I've heard videos where it's only accredited investors, this, that, whole nine yards, all right? Majority of the time, it is going to be accredited investors. Most of your opportunity zone funds are going to be a Reg C offering. So in the nature of what a Reg C offering is, they're going to be only taking accredited investors in. Sometimes they're going to be a Reg D offering where they'll be limited to how many unaccredited investors. Sometimes the Opportunity Zone Fund is going to be a crowd-funded Opportunity Zone Fund where they can take in unaccredited investors. That's their targeted focus. But then they'll be limited to how much that they can raise. So as you can see, the SEC puts these different type of stipulations on Opportunity Zone funds that are going to be raising money. So we've got an open fund ecosystem. We have a closed fund ecosystem. When you have an Opportunity Zone project, an asset, a real estate development, a business, what that means to that project or business is that they're really put into a position of really doing one of three things, okay? They're either A, put into the position of setting up an opportunity zone fund, raising money from capital gain investors, and using that money to invest into that development. So that's scenario number one, setting up a fund. Scenario number two, soliciting an opportunity zone fund that may have capital gains. Now, if you're going to solicit opportunity zone funds and you're a development project or you're a business, I would not recommend going and soliciting open opportunity zone funds, because open opportunity zone funds typically have the project identified, but they don't have the capital. So they're raising the capital for the project, and they're using that project to derive the numbers, the risks, and everything else like that, that as a fund, they're showing to investors. Now, closed funds, though, typically are well capitalized, but they don't have any sort of property or project laid out. And they're going to be on a time clock as a fund. Same thing with an open fund once money comes in. But a closed fund, because money comes in faster, their time clock, it starts when that money comes in, just the same way with an open fund, but typically they're more capitalized. So they're going to be looking for a project sooner, okay? So when you're a project, if you're not setting up a fund, you're soliciting a fund. So you solicit your closed fund. Market space. Well, since closed funds don't have to register with the SEC, and we don't exactly get the who's setting them up as far as like 8996 data from the IRS, now we have to go on a hunt to figure out where these closed opportunity zone funds reside at. So when you're a project, what you're going to do is when you're soliciting closed opportunity zone funds, you want to contact CPAs and you want to contact tax attorneys. You want to find out if they've happened to set up any, typically LLCs or limited partnerships for individuals with capital gains. It's going to be acting as a qualified opportunity zone fund, and to see if you can get your project in front of that particular fund. Because remember, those closed funds are going to have money, all right? Now, when we look at the ecosystem as a whole, and when we understand the dynamics and the numbers, all right, we look at and we say, okay, we roughly have an idea based on the 8996 tax filings. And again, the numbers are fluid. So it's not like, boom, this is it, because this isn't an application process where we get, applicant numbers released to us each month. This is one of those things that you do, you set up, you engage, and then you report. So, my best guess is we probably have, between open and closed funds, we probably have close to 3,700 funds all together across America, serving 8,700 plus opportunity zones. Now, when we look at the amount of money that is eligible to be invested into this program, you're talking a overall market cap of eligible capital gain that's in the trillions of dollars each year. And depending on how market conditions are, that number is either going to go up or going to go down, but it's in the trillions of dollars. We're talking in the Opportunity Zone Fund ecosystem, we're talking in the billions of dollars. We probably have somewhere out there in the neighborhood of, I would venture to say, close to 175, 185, maybe as much as $200 billion in altogether opportunity zone related activity that's going on right now in America. Now, what is beautiful when we look at this program and we say, okay, is it too late to actually get involved in opportunity zones? And when you understand the timeline of how this program started, this was like a baby that was born, spent the first 18 months of its life in the hospital, came home to its parents and was only home 90 days and then experienced COVID. So it was 18 months before we got our second set of tranche guidance that really opened up the doorway. Plus, we had to deal with COVID in 2020. So 2021 was the first real year that we saw major investment coming into opportunity zones. 2022 has been stronger than 2021. So now is the time. It's a blue sky opportunity. If you'd like to learn more about opportunity zones, check us out at opportunityzones.org, EAZYOZ.com, or get certified as an Opportunity Zone Advisor at ozadvisor.com. Until next time, this is Dave Silliman.